Hi there, it's Alan Borthwick here from Ducks Financial Services. Just another little quick video on one of the commonly asked questions we get asked. This question is one I get asked by a lot of first home buyers. I'm about to buy a house, I've got some extra debt, can I add that to the mortgage? Usual disclaimer, of course, all the usual stuff. This is not advice, blah blah blah. So can I consolidate my debts into the mortgage? The reason this gets asked, I think, is it's very common out there. You know, people, you go buy a car, you know, you've got a bit of debt, so therefore they go, well, sure, I'll add it to their, frees up your cash flow, you know, because obviously certainly the rates on the mortgage are way lower than the rates on most personal loans or credit cards, etc. So you get lower rates, and of course it's spread over 30 years, so your payments are a bit lower. The difference is, though, is that car loans, personal loans, etc., are either unsecured or they're barely secured. You know, they're secured a little bit against the car, but the car decreases in value quite quickly. Not really the same for mortgages. So what's the answer? No, but sometimes yes. So let's have a look at both scenarios. When it can't be done. So this is a bit cluttered, but we'll show you. So let's say house price 600 grand. You've got a 10% deposit, which is 60 grand required, and that's what you've got. You don't have any more than 10%. So you've got 20 grand of debt. If you use some of that 60k to add to the, you know, to reduce your deposit, you're only going to have 7% deposit, right? Now that means, and the banks aren't doing over 90% loans at the moment. So that's effectively what happens when you add debt to the mortgage. It reduces your deposit, your equity, and that's what the banks look like. So if it's going to put you over that 90%, it can't be done. On this side, it can sort of be done, right? If you've got a 20% deposit and you use some of that money, reducing your deposit down to only 16%, then you could potentially do that. But once you drop from 20% down to deposit down to lower than that, you get more questions asked, you might have to get a valuation, the rates aren't as good, so it might end up costing you more than the debt you're consolidating. So it can be done, but it probably shouldn't be without advice. So summary for this, it certainly can't be done if you don't have a 10%, you know, if you've only got minimum deposit, because it's going to put your effective deposit over under the minimum. When can it be done, or may be able to be done? Let's say in this case, same house price, that's some required deposit, but you've actually got 80 grand. So once we take off, we use some of that money to pay your deposit. Now you're down still having 10% deposit, $60,000, 10%. The bank still might not want you to do it. They don't like people who don't have 20% deposit to use some of that money for other stuff, but that's where we come into it. We'd argue that for you. Over here, even easier, right? You've got 140 grand. You only need to have 120. So paying some of the debt down gives you 20% deposit. Nice and easy. If it makes sense financially, we should do it, right? So really, we're not adding the debt to the mortgage. We're reducing our deposit. That's really what can be done. So here's some questions but what if you've got more than 20%, but it's all in your KiwiSaver? Short answer, then you can't do it, right? The KiwiSaver money for your deposit has to go into your mortgage, right? It has to go into paying for the house. Now, 6 months down the track, you can, that's long enough. You can go back to the bank. You've now got equity. What the hell? What if the house is worth more than your price? So you've had to get a valuation. It's come back, significantly higher. You think you can use that equity. Banks aren't a fan of that. They will let you buy on the basis of the price or the value, whichever is lower. So that $600,000 house, if it comes back worth $620,000, $630,000, initially you can only use the $600,000 price. They won't let you use equity. Banks don't like you buying equity. It's just a thing they don't like. Again, in 6 months' time, assuming the market hasn't gone down, we can probably do it. We might have to get another valuation if you got a valuation because you had to do it, but we can look at that at the time. If you are going to do it, though, when should you? Don't do it until your advisor or the bank says it's a good idea, right? I'd rather you have a bigger deposit and a bit of debt than to have got rid of some of the deposit and then you need more deposit later on. So in the previous example, you're all keen to buy a $600,000 house. You've got 65 grand. You think, oh no, I'll use $5,000 to pay down some debt. And then you find a house that's perfect, like $620,000. And you need $2,000 more deposit to get the 10%. If you haven't got it, you can't buy that house. So when we're doing this with people, we say hang on to the debt as long as possible. until we get the bank sign off on it, and or we know what, like you buy a house that's cheaper than we expected, then we look at doing it. Okay, so short and sweet. If you've got any questions, comment on the post on either YouTube or the Facebook post. Flick me an email with any questions, and if there's any other topics for home buyers that you want me to do a quick video on, let me know. Thanks very much for watching. Talk to you later.